Hi everyone, welcome to another Weekly Forex Forecast for the week ending March 27th, 2020. My name is Justin Bennett with Daily Price Action, and in today's forecast we're going to discuss the EURUSD, the Pound USD, the Dollar Yen, the New Zealand Dollar versus the US Dollar, as well as gold or XAUUSD. So I'm going to discuss how to cope with that increase in volatility, as well as some key levels to keep an eye on this week, especially with regard to the EURUSD. So let's get started right now. Quick disclaimer that today's video is for educational purposes only. All views are my opinion and are not intended as investment advice. Forex is a high reward, high risk business, and you should not trade with borrowed money or money you cannot afford to lose. See the description of this video for the full disclaimer. Before we get started, be sure to hit that subscribe button and also click the bell icon so you get notified every time I post these videos. Also check out the join button where you can become a member of this channel and receive 5 to 10 analysis videos from me every single week. I'll show you the key levels I'm watching and how I'm approaching that pair, so you'll get trade ideas from those videos, but you're also going to learn how I trade price action, and that's going to make you a better trader. So first up we have the EURUSD. We've been discussing this descending channel for several months, and note that this channel extends from that 2019 high. So the top of this channel is well defined, as is the bottom. So we talked about this channel back here when the pair was coming off support, and I also pointed it out when the pair was coming off of resistance back here. Now you can see where the pair closed above that channel top, but then it closed right back below it. So this up here was a false break. And as I've said multiple times, a false break to one side of a pattern often triggers an extended move in the opposite direction. Notice the false break was to the top of this pattern, therefore a move lower last week was likely. So if you watched last week's video, you know that I said this close on Friday. So this close right here confirmed the false break. It also meant that this 111.70 area would become resistance, which it did. And another level I pointed out in last week's video was the April 2017 gap that was left open at 107.24. So this level right down here was the open gap from 2017. And if you watched Thursday's session, you saw that the pair put in a low of 107.25, followed by a 100 pip bounce higher. So I pointed this out in the members area and said that it looked like that gap was closed. Now, of course, Friday closed below 107.25, but our target last week down here was in fact reached by the pair. Despite the increase in volatility here, this was an easy trade in the sense that we never really got a rebound. So the pair really moved directly lower into that 107.25 target area. Now, unless this is a false breakdown here, this looks to be a breakdown as well. So unless this was a false break, and the only thing that's going to confirm that false break is if the EURUSD moves higher this week and closes back inside of this channel bottom somewhere around 107.50. So if we get a daily close back above 107.50, that would confirm this false break. But as of right now, I have to assume that this area right through here, right around 107.20/50, is going to act as resistance this week. As for key support to keep an eye on the way down, we have 105.20 followed by 103.50. Okay, so if you notice here on the weekly time frame, remember that 107.25 was that open April 2017 gap right back here. So this was the gap I was referring to at 107.25. So that area becomes resistance, and you can see how 105.20 or so back here was support, resistance, and then support. And 103.50 is, of course, that 2016 low. So these are going to be 3 key levels that I'm going to keep an eye on for the week ahead. So as long as the pair remains below that 107.25 area on a daily closing basis, that region is intact as resistance, and 105.20 and 103.50 are both exposed as key support. Next up, we have the British pound versus the US dollar, and this was a massive sell-off last week. The volatility here is unprecedented. The only time we saw volatility like this was back during Brexit, and you can see that Friday's candle, all right, so this may look like a normal candle right here, but until you compare it to the type of candles we had back through this area, all right, during what I would call normal times, this candle spanned over 400 pips. That is a huge daily range. Whenever you start to see volatility like this, yes, it's very enticing to see markets moving so far so quickly, But you have to be careful here because even the slightest 100 pip spike or 200 pip spike can take you out. So my suggestion anytime we enter into an environment like this is to either not trade that currency pair or reduce your position size by at least half. So if you normally risk 1% of your account balance, risk 0.5%. If you normally risk 2% of your account balance, risk 1%. Of course, you always have the option too to stand aside and ignore that currency pair. So the British pound is one of those pairs that you may want to just ignore because, again, the volatility here is extreme. And even if you get the trade right, the direction right, with this volatility, it does not take much to stop you out. So we have a few things happening here. And if you'll remember, we had this 2019 channel that I'd had on my chart for several months. And it was actually this channel top that rejected the pair back here. So notice how this ascending channel directed the price action for several months. And then we had this breakdown right here on this candle. It then tested this top and perhaps even closed above it, depending on how you draw that level. We then got this rotation lower, this aggressive rally back into this channel bottom, and that's what triggered this massive sell-off. Now, of course, we also have a small descending channel here based on some of these highs and lows. So right now, though, the British pound is trading at an all-time low. So once it broke below this 2019 low back here, we are now trading in what I call no man's land because we've never seen these levels before. So all I can really do at this point is draw a level at that 2019 low and also mark a level near last week's low around 114.50. All right, so for the week ahead, this 120 handle is going to be resistance, which again, that's the 2019 low, and 114.50 is going to be support. I will say that I'm not a fan of trading the British pound right now simply because of the increase in volatility. Again, Friday's candle alone spanned over 400 pips, and also the fact that structurally the pair is unfavorable in the sense that we're trading at all-time lows. So if I don't have a pattern to play or multiple key levels in play, I'll go ahead and stand aside for something more favorable, even like something like a EURUSD where we have more key levels to trade as well as a defined pattern that we can play off of. The dollar yen is another currency pair that has been incredibly volatile in recent weeks. So we have a few things happening here, but I want to start by showing this multi-year wedge pattern that I've discussed several times. So if I move out to the weekly time frame, you can see where we have this lower level that extends from some of these 2013 lows, and then we also have this top level that extends from the 2015 high. Now, just like the EURUSD that false broke to the upside, we have this close above this wedge top followed by a close back below it. And again, what suggested that that false break was likely is the fact that the dollar yen pulled back into the support level so aggressively after closing above it. So this was the close above it, but notice how aggressive this pullback was into support. So this right here indicated an increase in selling pressure up here, and this close confirmed the false break. Now again, a false break to one side of a pattern often triggers an extended move in the opposite direction. And that's exactly what we got here. This sell-off spanned over 800 pips in a matter of days. So what you can see though is that since that time, the pair clawed back all of those losses in about the same period of time. Furthermore, the dollar yen also closed back above this 109.50 area on Thursday. So this candle closed back above it, and I even wrote on the blog that this area right here became support. So it was all going to come down to whether or not buyers could hold the pair above 109.50, which of course they did on Friday, and you can see where we bounced from that area. So moving forward, this does appear to be a V-shaped bottom. Notice how we have this aggressive sell-off followed by this aggressive rally. So this V bottom does signal strength, and again, as long as 109.50 holds as support, I think we have to respect the potential for further gains. Now, 112.20 is of course going to be resistance, as is 114.50. Now, the only thing that would negate this idea and send the pair lower would be a daily close back below this confluence of support around 109.50. So as long as it holds, 112.20 is exposed and perhaps 114.50. If we do see the pair rotate lower and close back below it, we have 108.50 followed by 106.80. And quickly, this is another pair where the daily range right now is incredibly volatile. We have moves of 200 pips, 300 pips in a single day. So unless you're trading with a very small position size or you have a wide stop or both, that's especially true when you consider the fact that we've had 2 false breaks now in recent weeks. So we had this false break at the top of this pattern, and we also had a false break down here. So given the false breaks and the increase in volatility, it may be best to stand aside for now and wait for a new pattern to develop. Something will develop. It's only a matter of time. It always happens again and again in the markets. But right now, the dollar yen is a bit indecisive in my opinion. So if you'll remember a few weeks ago, I talked about the New Zealand dollar versus the USD, and we looked at this multi-year wedge pattern that extends all the way from the 2000 lows. So these are the 2000 lows back here. We then have the financial crisis low as well as this low right here. The top of the pattern is also well defined with this high right here, as well as this one. So we recently had this close below that wedge support, which did confirm the breakdown. And I even mentioned in the members area how I got short right up here on this candle. And I actually took some off last week to book some profit and also reduce my risk, but I still have a piece of this on. And as of right now, it's over 600 pips in profit. The key levels that I wrote about last week still stand, and that includes 6,200, although I'd be surprised if we get back to that level. And we also have 59.20. So this area right here, if you notice on the monthly time frame, you can see where 59.20 was a key level back here. So it was support back here, and before that it was resistance. So 59.20 is going to be one to keep an eye on this week, as it could introduce a selling opportunity. And we also have 56.50 support. So notice how the pair closed back above this level, and 56.50 was resistance back here, resistance, and then support. All right, so 56.50 is going to be support, 59.20 is resistance. Now, if we see the pair break down and close below 56.50, we could see a return to 53.20. And as I mentioned a few weeks ago, I'm not discounting the possibility of a run at these financial crisis lows around 49.50, maybe 4,500. So this low down here is very much in focus over the next few weeks and months. Last but not least, we have gold, or XAUUSD, and this is another market that has been incredibly volatile. We saw a range last week, mostly between this 1450 support area and also 1515. So these are 2 key levels that I pointed out last week. But one thing I did say is that I do feel that gold has more downside before we're going to see a return higher. And one reason I think that is that if I move out to the weekly time frame, you can see how this area between 1360 and perhaps 1380 has multiple highs back here. And this is the region that I do think gold could pull back into before we see that move higher, because this is also the 50% retracement of this bottom down here. So this 2015 low and this recent high. So notice where the 50% lines up with these recent highs back here. And again, this is why I think that gold could have more downside before we see the metal move higher. But in the short term, I do think that 1515 is resistance, 1450 is support. Now, if that support area fails this week, we could see a pullback into 1380. So this is the next key area. Again, that's between 1360 and 1380. And that's just based on some of these highs back here, as well as the 50% of this recent range from the 2015 lows all the way up here to this recent high. So if you're a swing trader like myself and you're looking for an entry here, this is a time to just kind of stand aside and wait for the market to play out, because if we do see a pullback into this 1360/80 area, that could present a long opportunity for a rotation higher. But until that time, the pair is going to be incredibly choppy and we're going to see more volatile days ahead. So trying to get in now is not ideal in my opinion. So if we see 1450 fail, that 1360/80 area is an area of value and could trigger that move higher that we're looking for from gold over the next few weeks. But until that time, I do expect further losses here unless we start to see some of these resistance levels get taken out on a daily closing basis. If you enjoyed this video, give it a thumbs up, leave your comment below, and be sure to subscribe to my channel. See you next time.